First of all, a very warm welcome to PyData. It's a great honor for me to kick off PyData in a sense. So this tutorial tomorrow is actually the first tutorial in a row of, I think, pretty productive and interesting tutorials today. But it's also kind of a special thing because we could win Eurex, the derivatives exchange, as sponsors for that. So registration for this tutorial was open, but of course, all the people attending PyData tutorials were also able to register. My name is Yves, and I'm Managing Director Europe for Continuum since last year, June, where we founded the company. You can read it here, Continuum Analytics Europe, GmbH. Before, there has been already people working here in Europe for Continuum. But right now, we are doing the stuff a little bit more in an organized fashion and have founded specifically a company to cover the European market a little bit better, providing as the company, as the main headquarters do here in Europe, the same things like training, product sales, and also consulting services, of course. I will come to myself in a second, have been working in Python with Python and finance for almost 10 years. But before I start and go into the details, here you find, again, the links to both. One, the presentation you see here. This is the first link, and the second link is the link to the IPython notebook. So if you have your notebook with you, if you do have installed Anaconda and are using IPython, you can follow real-time the stuff. There's a question.
How do you access the internet?
There is a guest access. So actually, there's no password required. You just have to connect to, I don't know, it's called level 39 guest. Level 39 visitor. OK, thank you. So, and the rest was at least on my machine done automatically. So you should be able to access high-speed internet. Does everybody has a notebook with you? So everybody is able to download, follow the stuff. So I've intended to do the tutorial interactively. So I've brought with me a couple of exercises. I don't want to present only, in a sense. Don't want to provide information. I want to get you work a little bit in the morning here on Friday, the last weekday we have this week. But if you have trouble accessing or finding the link, you can also go to my private website. I will show it in a second. There I have the links again. If you go to hilpisch.com, and it should be the fourth one here, you have the links again. Just go to hilpisch.com and click until you find Eurex tutorial. There you find also the links to both the slides and the IPython notebook that I'm using. But this IPython notebook that you'll find there doesn't include the solutions to the exercises. So this is like at the university where you have to write your exam. Does anybody has found the information? If not, you can raise your hand maybe later on. Only a couple of seconds about me. As I said before, I'm Managing Director Europe for Continuum Analytics. I founded another company, Vision GmbH, which we call the Python Quants recently, already in 2005, or it was actually at the end of 2004. So we've been in this space for quite a while. I'm also a lecturer for math finance at Saarland University, where I use Python, of course, to illustrate all the mathematical models that I try to teach. I'm focusing on the financial industry since I started working in 1997. So both insurance industry, banks, recently exchanges, so the connection to Eurex, for example. I've written a book. I can show it here. If you're interested, we will put them on the Continuum desk. It's a book about derivatives analytics in Python. It contains 5,500 lines of Python code in it. And it exposes models like stochastic volatility, jump models, calibration, Monte Carlo simulation. All these are topics. Actually, an outgrowth of my work and of the lecture. As I said, you will find a display copy at the Continuum desk outside over the whole conference later on. I'm currently writing a book, Python for Finance for O'Reilly. This one is actually a finance book using Python. The other one is the other way around. So this is a Python book against a background of financial applications. My background in educational topics is I have a doctorate in mathematical finance, credit and business administration. And apart from family and Python and finance, I like martial arts. Python for analytics. If you're working in a bank or any other corporation, you might be faced with a couple of problems when it comes to data analytics. The first one is usually data is not stored in a single source. you won't find the data that you're looking for, usually not in a single place. If you find the data maybe then in multiple sources, okay, you can live with it maybe, but there are different formats where data is stored in. And the data is also differently structured, from completely unstructured to like very structured formats like multi-dimensional arrays, which we are used to in Python, for example. And when you have the data and when you can cope with all the sources, formats, and structures, then the data, you might notice, is probably or most probably incomplete, actually. So you have to take care of this as well. There's so many conventions. I don't know if you're working in the finance industry. I mean, you will have seen like maybe 10, 20, maybe even 100 different ways to store datetime format. Though a typical issue in finance is like conventions with regard to storing datetime information. And the other one is like, can software, can Python, or can any library that is available help us with interpreting the different stuff that we see? Or for example, we will see this, pandas help us with interpreting the different conventions for datetime formats. Last but not least, if you have solved all the problems, of course, performance is a topic. In today's environment, not only at financial institutions, in almost any other place, data volumes, data velocity is growing tremendously, so performance comes to an issue. By raise of hand, how many of you are working in financial institutions? Well, there's not too many for the topic. In research, academics? Oh, not too many. What are the others doing, actually, when it comes to financial analytics, actually? How many of you just use Python? I think this should be a no-brainer. So you're not a newbie, interested just to learn. How many of you use IPython? Oh, okay, so I have to take careful. Only experts in the room. How many of you use pandas, for example? Also, well, so you will see a couple of things today that might be quite familiar to you, but I hope, nevertheless, you will see something new. And last question, how many of you think these are real problems in data analytics that we see here? Fortunately, otherwise there wouldn't be any consulting needs out there, which our business model is centered around. But I think also that it's not only data itself, it's also organizational issues that make data analytics sometimes a little bit hard. For example, different departments in a general sense. They might have different ways to organize, to store, to manage data, leading to something usually called data silos. Or in people itself, usually where there are the analytical skills, people that understand the business, that might be able to ask the right questions. They might not possess the technical skills required to answer them by data analytics. The other way around, if you're a computer scientist, you come to a new company, an industry which you haven't worked in recently or never maybe, then you might not be able to ask even the right questions. So there's kind of a disparate thing in terms of like different departments working differently, people having different skills. So in the end, what we are striving at Continuum is like overcoming all these problems in a sense by the way of revolutionizing data analytics and visualization by moving high-level Python code and domain expertise. I mean, this is maybe the more important part, closer to data. The vision actually rests on 4 pillars. The first one is simplicity. If you think of kind of a line manager who has maybe lots of questions, which could be pretty easily answered by the right analytics approach, it shouldn't be too complicated. Not going to university for another 3 years to learn like doing it. So it should be simple. The other thing is it should be interactive. People don't want to like to wait for too long. If they have a question, if they do analytics, they want to see the results interactively and not like after a week or a day or even half an hour might be too long for that. Collaboration. Today, data analytics should be a collaborative effort. I mean, in the research space at university and academics, people are more and more getting to this. I'm not sure whether all corporations have jumped on this train already, but collaborative, shareable analysis might be also a huge thing in the future for corporation. And last but not least, once you've solved all the other problems, scalability and performance are another issue. So this is, you can read it here, the vision at Continuum that we have and against which all the stuff that we do at Continuum have to be judged and have to be seen. And this might be kind of the framework in which we discuss the stuff that we develop and provide at Continuum, be it the training, be it the consulting services, or in particular also the products. The tutorial today will focus on general purpose financial analytics. So I think it's not too specific what we do. I always try when I do a tutorial to be not too hard, and also that if you download the notebook, then you can replicate everything on your own. So for example, if I would have like an API to Bloomberg and would like draw data from Bloomberg, and you don't have any Bloomberg access, so it would be worthless in a sense. So of course I will rely on public sources, which you might be aware of, like Yahoo Finance and stuff like that. But I will have also maybe one source which you're not aware of, which you can use for even getting high frequency data for your financial analytics. And it's all based on examples, not too much theory, not too much explanation. It's all interactive, and if you have downloaded the IPython notebook, you can follow it pretty easily. Some Python fundamentals. Fundamental Python libraries. By the raise of hands, you have already declared that you are Python experts. It also seems that you are doing much of interactive analytics with Python because you're using IPython. You know pandas. I mean, all the other things around that, or either they are the bases, like NumPy, SciPy for pandas, for example, or are heavily used by pandas, like PyTables and Matplotlib. So I don't want to go into detail here. Much more, I maybe come back later to the deployment issue in terms of what Anaconda and Vakari could do in this case. If you know pandas, you know pretty well that the problems that I've cited before are very well addressed and I think pretty good solved by pandas in many, many circumstances. And you still notice by the genetic DNA that you find in pandas that it has its origin in a hedge fund, in a quantitatively oriented hedge fund, AQR Capital Management, and we should be all happy that they decided to outsource the thing and let Wes McKinney do an outsourcing project or work on the project later on when he left AQR. So now today we benefit from the stuff that he has developed specifically for a single company, and I think this should also be a kind of a blueprint. We at Continuum, the majority of stuff that we do is also open source. We try to improve the whole infrastructure and not mainly doing something that is proprietary. Of course, we are a company. We need to make money in the end and a profit, but still, as you might know, we have lots of open source projects like Blaze or Number, for example, to name just a few. First, interactive analytic steps with Python. So now we come to the tutorial part. I want to skip the slides right now. I mean, the slides that you see here are all based, of course, on my IPython notebook, but I have this open as well here. So I will now change to the IPython notebook. Is there anybody in here who doesn't know NumPy? Oh, I said only IPython experts. So we can start working with that. As I said, I try to always provide reproducible stuff. One thing I claimed before, so I do it here as well. And the easiest thing to reproduce things is to work with, here in this case, random data. What I do here is just to generate a data set we want to work with. So if you're accustomed to that, maybe it's not that interesting. Usually I start with that just to illustrate how you can work with IPython and how simple it is, even for those people who are not like expert programmers. I think this makes the beauty of Python as well, how fast you can get started with doing these interactive things here. And especially, I mean, this is usually not that or impressive to generate random numbers in the first place, but what might be more expressive is my experience from tutorials and also trainings that I give is kind of how easy it also is to visualize things. And as we used to say, a picture might say more than 1,000 words. This is at least my experience, both in a corporate context, but also when I teach, as I said before, at the university, providing simple ways, simple means to visualize your results or to inspect data. It's kind of a very, very good thing to have. I mean, this is also, from my point of view, one of the major benefits of using R, for example, generating wonderful plots pretty easily, like, as they always say, publication-ready things. Matplotlib has gone a long way. There's still a little bit to go, get to the quality of the R plots, but I think with a little bit of trickery, you can get there as well. You have many options, of course, to plot stuff. This already looks a little bit like financial data, like kind of a random walk. Not maybe down Wall Street, but here down our random numbers. And on the other hand, this might be kind of the right thing because I just used this first thing to convince people that Python is not as slow as many things. So I recently, in a project context, we work with a data service provider. So they are data experts. They're providing an event database, which is kind of for like high-frequency financial data or high-frequency advertising data and stuff like that. And they used to do C#, multi-threading, say, well, the stuff we did in Python is so slow. This is so slow. We can work with it. So, and they came up with kind of custom Python code, which they wrote like as they would writing C# or maybe C++ or C, you name it. But in this case, they were C# guys, and they provided this. And it just, by replacing what they wrote with the data mean, because it did nothing else but kind of calculating via a loop and stuff like that, the average of some data set, they said, well, this is also slow. Well, of course, I showed them if over quite a large array, this took like 5 seconds. But using a simple call to the array, a method call to the array, this is kind of done with the same data set in 40 milliseconds in my example that I provided them. So this is also one thing I like to stress, and I've in my current book, I write maybe a whole chapter about that. You can do the same thing, or you can accomplish the same thing in Python with many, many ways, many approaches, even many paradigms. Python allows you to do many things, but not all are like similar or comparable in terms of how they perform, how compact they are, how Pythonic they are. I mean, this is the most often used word, I think, how Pythonic they are. I mean, this is Pythonic. To loop over this array and try to calculate the mean by yourself wouldn't be considered Pythonic at all. Maybe if you do like stuff like dynamically compiling with NumPy, with number, for example, then you might write a loop by yourself. But in this case, there's no need to write a loop, and you see, for people doing statistics, it's kind of usually one click away that you get kind of even more complex stuff like the correlation coefficients with the 5 columns of data that we have here, and you have the correlation matrix. But this should be all kind of pretty standard stuff for you. But now let us come to the first financial analytics example. Has everybody of you by now downloaded the IPython notebook and has internet access and everything is going, or is there any need for further help somewhere? So the same simplicity and beauty that we've seen with NumPy, at least for me, it still is kind of beautiful and simple. We find even on a higher level when we use pandas. And here in this case, I also use the data reader function from the pandas IO data sublibrary. So I import these. And the data we want to retrieve right now is from finance@yahoo.com. I think is by now the most popular financial resource, even if the data is usually quite crappy. So you should be careful if you invest your own money. There are usually no stock splits and stuff like that. So the data is really, don't bet your money, just do examples and tutorials based on that. Not bet your money on the data you get there. There might be kind of huge, let's say, errors in the data, which might lead to different conclusion, either on a detail level or even on an aggregate level. So don't rely on that for real business purposes. And what we want to read in here right now, in spirit of Eurex sponsoring the thing, Deutsche Börse, is to import data for the German DAX index. If you would like to work with the VSTOXX, for example, we will do this later on. The ticker symbol is provided here as well. You can also look up any other symbol on the finance.yahoo.com page. So there's one syntax change. I don't know if you're working with pandas, which version you are using. I recently upgraded, of course, to .13, and you need to call the info method to get like the overview. In the new version, pandas will try to print out to provide all the data stored in that. So this might be, in this case, kind of a table with more than 1,700 rows included in it. So you might want to call the .info or the info method in order to avoid like a huge printout in this case. Actually, pandas was intended to attack things like index, label, structured data in the first sense, like time series data or panel data or multi-level index data. So as you can see here, it makes it pretty easy and pretty simple to have like, something in between a NumPy array or even a structured NumPy array, and also something in between the SQL database table. I mean, if you do a little bit more sophisticated analytics like Boolean operations or SQL-like statements, pandas is also pretty good. So I see it more like an in-memory analytics thing that you can use for SQL-like stuff, which is pretty performant. And if your memory is large enough, you can get quite amazing things up and running. Another thing that is pretty impressive, I think, is vectorized operations on whole time series or even whole data frames. Here in this case, if you, for example, want to calculate the daily log returns based on the closing values here, it's only a single line of code. If you're used to another language coming from like C, C#, JavaScript, or whatever, but not so much in MATLAB. And MATLAB would be kind of the same thing in R as well. But here you have both worlds, and you can use, in that case, the vectorized operarization in the sense that you calculate values for a completely new column by just referencing the input columns that you want to have here. You see you have the NumPy log, the universal function from NumPy, the logarithm, the natural logarithm. You take the column that you're interested in. You shift the same column by 1 day such that you get to the daily log returns, and the result actually is that you have a new column, and which you can then pretty easily plot as you are used to. So in my current book, I tried to write up all the parameters that you can provide to the plot method. I not only tried, I did it, but it's kind of a huge table. So you have many, many functions that you are used to in matplotlib if you use this heavily, which are kind of wrapped in the pandas plot method. As you can see here, you can decide whether you want to have subplots or not, the style, or for example, the size of the figure. So what we see here, this is kind of a pretty typical graphic that I use during my lectures just to illustrate that we have volatility clustering. You see here, this is typically called volatility clustering, where you have kind of periods of high volatility followed by others where volatility slows down. And usually, and then we are at the next effect, you have the leverage effect, which says that when the market goes down, volatility goes up, and the other way around. So currently, and this is not good for exchanges, which live off transaction costs and others, who are in the trading business, we have a very calm environment. Volumes are down, nothing is happening because, as you can see, we have a long bull run like here, and volatility is pretty slow here. So this is good for long investors, but not too good for others who might want to live off the trading volumes in the first place. One of the major assumptions of the Black-Scholes option pricing model, for example, or to this end of any other kind of standard model based on the normal distribution, is that volatility is constant over time, and we all know it isn't. If you want to check here how volatility evolves over time, we have just seen, this is not a volatility measure, this is just like what I did before is kind of interpreting volatility. Here we only see the returns. But we can easily get to a next step by using the rolling standard deviation, where we say, well, take a window of 252 trading days, scale it by the correct number. Here's the square root of the same number, and we do it over the returns, and we end up with our moving volatility, as I've called it here, the column, and we can compare this again, and we see, of course, as we all know, volatility is all but constant. Measured over the last year, we see volatility is changing quite a bit, and as I said before, much recently, volatility has pretty come down, which is good for some people, but not to anybody in the industry. So now I want to come to the first exercise. I have the solution already in here. If you have fired up your IPython notebook, you have everything downloaded, I want you to implement the following thing. I might now switch back to the presentation so you can read it maybe a little bit better. So we have it here, and I can leave it on. I want to do with you a backtesting exercise. Backtesting in the sense that we have an investment strategy, and we want to test how this strategy would have performed over the time horizon that we have available here. So I fixed the date. You can choose the date. Otherwise, if you like to, but you can have the same starting date as me, so we might end up with the same results. What I would like to do with you is kind of first implement the following things. We will have a strategy based on 2 trends, 42 days, 2 months, and the whole year. What is possible for the investor is to go long, to go short, or to hold the wealth, I would say, all the money that is there in a cash position. Cash, I will say that later, or it's written later down, doesn't yield any interest. If I'm long, I will earn the returns of the market. If I'm short, I will return the negative of the market. This is the idea behind that. The signal generation should be done as follows. I invest, I go long when the 42-day trend, the short-term trend, is more than 100 points above the one-year trend. And I go short when the this shouldn't be 20 points, it should be 100 points, but no matter what, I wanted to do it symmetrically. Maybe I change it later on. This is just a text, it doesn't go through the Python code later on. This should be 100 points as well. Below the trend, or you can do it asymmetrically as well. There's no kind of economic reasoning behind that. But start maybe with a symmetric strategy and invest in cash if the 42-day trend is within this range of 100 points. So this is pretty efficient to do with pandas. And we might start by, or I ask you how we should approach this. I mean, the first thing should be pretty simple. If you're used to work with pandas, if you're used to IPython, to generate the 42-day trend and the 252-day trend should be pretty simple. Maybe you should start by trying out this, adding 2 columns and adding the moving average, another term for that. Or the pandas term is a rolling mean to generate the 2 new columns containing the trend numbers. Once again, I've used rolling standard deviation and the corresponding function to do the moving average is the rolling underscore mean function. If you have any specific question, raise your hand.
Might be a silly question. Of course, you're going to get not a number at the beginning because there's not enough periods. Do you drop it, or what do you do with the number?
No, just leave it.
Just leave it?
As I tried to emphasize beforehand, pandas helps you dealing with not a number, in a sense with incomplete data. Of course, your 42-day trends is a good remark. It's not a silly one. Your 42-day trend will start after 42 days. The first time you have a data set of 42. And the 252-day trend will start after 252 days. It's the first time you have the number at all. But just leave it in there. In the end, we will have kind of a still symmetric table structure, not different lengths with that. Is everybody ready or still? Can't imagine, only IPython experts in here and pandas experts. I do it, by the way, with the Eurex 50 data, but the whole exercise go through with any kind of index or stock or whatever you want to do. My analysis starts as before, as at the end of the first quarter 2007, but this is also arbitrary. You could choose any other starting date. And here you see how you can come up with the trends. I tentatively call them 42 and 252 day. Set the windows respectively to 42 days and 252. And of course, what this whole operation does is not only calculating the stuff, but also generating a new column in our existing data frame and putting the calculated time series into this newly generated column. Once you have accomplished this, you might want to have a look at it graphically. This was not part of the exercise, actually, but I think it's always nice to check what you've calculated. And here you see also what we've discussed before, the 252-day trend line. The red one is starting after 1 year, so to say. The other one is starting, of course, 11 months earlier. And you see what's happening here. You have the green line, which is pretty close in a sense, which resembles more the original index movement. And you have the red one, which is a little bit slow, more slowly in adjusting to what's happening. It's what you would expect. And this is where the idea comes from. You see, as long as the short-term trend lies below the long-term trend, you would say, well, this is a downturn market. We are short-term, we are like below the long-term trend. The other way around, if the short-term trend crosses the long-term trend, then you say, well, this is a good signal. You have to invest. Now markets are going up. The question is only how far this will take you. So you have a couple of parameters to adjust that. What we completely ignore here is like transaction costs, slippage, operational issues, and stuff like that. But by now you should be in a position either with the VSTOXX 50, as I did, or with any other index or stock, to have a figure like that. Because this is what you need to do the next steps. It's the basis are the trends. Is anybody ready so far? Or should we wait a little bit more? No reaction in the faces. I don't know if it's good or bad. Oh, well, kind of a little bit of nodding right now, starting. So what's the next thing? The strategy is based on the difference. How can we calculate the difference between the two trends? What operation do we have to implement?
A vectorized subtraction.
A vectorized subtraction, completely true. Try to do that. Try to simply calculate by a vectorized operation the difference between the two trends and store the result again in a new column. So once you have the difference, what do we now have to do? We need to make a decision. We need a signal. How can we model that? I think this is all about financial analytics, financial modeling. How can we model the decision? How can we model what's going on? Going long, going short, going cash? What do we need? Yeah?
You make another column which is just like a string and it says long, short, or cash.
Or based on a threshold?
Yeah, the threshold. We had the threshold I wrote it up a little bit confusing. But nevertheless, the threshold, say 100, either plus 100 or minus 100. These are the thresholds. Then, yes, how can I come up with like the strings in itself?
It's like it's a predicate, vectorized predicate. So you say, if this is true, then set that column to that level.
Okay. If this is true, they can either do it by if.
No.
There's something.
Use like np where.
np where, that's the right way to go, yes. np where, then the condition, then if the condition is right, is the next parameter. If the condition is wrong, the last parameter. That's true. But does it suffice? One where statement, think it through.
So 1, 0, 1. 1, 0, minus 1. So where it's above 1, where it's in hash 0, where it's short minus 1.
This is one way to go, yeah. For example, or you have I chose 2 ways. There are many ways, as I said before, to come up with that. But if you have a look at it, how I solved it, I defined a signal difference. Could be 100 or 20, or you could have also 2 thresholds. Actually, I realized that I didn't do an extra column. So I just calculated on the fly the differences, and I say if the difference is larger than our threshold or smaller than minus the threshold, these are the 2 conditions. In the first case, I first generate a new column, which I call signal, and I say if the difference is larger than 100, then put a 1 into the column, otherwise a 0. And then I pick all those cases where we have the opposite condition, that is smaller than minus the difference. There I put a -1, and I let the index signal column in all other cases. So you propose to have a string instead of a number. That's perfectly correct. You can do that. The only beauty of using numbers is that you can calculate with them. So with a string, calculation is pretty hard. So if you say, well, invest times something, this does not really work. In Python, it works. If you say invest times 5, you will get 5 times invest. But this is not where we want to end up. The idea behind this right now, and now we are pretty close to the finish, is to say, well, I said it already when I introduced the exercise. Going long means I return the market returns. I earn the market returns. Going short means I get the opposite of the market returns, negative the market returns. And doing nothing, being in cash, I earn nothing. So this is already like hinting to how we want to go forward. So in the case where we are invested, we are earning the market return. This is multiplied by 1. In case we are going short, the market return is multiplied by -1. And if we are in cash, the market return is multiplied by 0. So, but we need the market returns, of course. We've calculated them before. So the next 2 steps you should be able to accomplish, both to calculate the market returns and then to calculate your strategy returns. It's only 2 steps away. And finally, yeah?
Is there a nice way to chart? So if you use the other chart, like obviously the signal is on a different scale, but can you do, use the signal to sort of have a shaded part of the plot so that you can see, where it's shaded, that's where the signal was on
This is with pandas. I would doubt that it's possible, but if you go native to matplotlib, it's possible to shade areas. You have shading functions there. Yeah. Even for like fragmented stuff. I have, for example, I mainly copied it from the matplotlib website, where you have like typically what you're describing is kind of having, for example, the area below a function, the integral value, which could be like differently shaped. You have these functions in matplotlib to shade areas, and it's a simple way, so to say, to shape the rectangulars. But you have to do it manually. There's no kind of like convenience function which would do it automatically. But you can write one, so provide it. Will be pretty helpful. But what I do, in a sense, maybe it's not the same, but it's similar to what you proposed. It's kind of visualizing the signal, and that you can easily see what's going on. In the beginning, there's nothing. This is mainly due to the fact that we don't have the data in the beginning. We have not the number values due to our moving average calculations. But then it starts with a -1. We're in a bearish market. Then it goes to 0. Then we invest. It goes to 0 back again. This is what we would expect. So we would expect to see the short-term trend stay within a range of 100 for quite a while before it drops below. So you see here we had a longer period where it stayed around the long-term trend. Then you would invest, you would disinvest, and so forth. So I find it quite a nice way to visualize that, but your proposal, of course, will be maybe a little bit nicer in the end, to have it all included in one thing. But once again, the beauty of using this -1, 0, and 1 approach is that you can use this to multiply with other quantities. Anybody ready so far? So, as I said, we need log returns. We have done this before for the DAX, in the DAX example. This is mainly the same line of code that we've seen before. And our strategy, maybe a little bit confusing the word, but what I mean is kind of the returns of the strategy I easily get by multiplying my index returns by the signal that I've calculated before. So this simplifies a little bit in the manner that we're working with closing day data, in a sense that, well, I check at the end of the day where the short-term trend stands in relation to the long-term trend, but at the end of the day, I'm not able to make a decision to rebalance the portfolio. So usually, I've implemented this a little bit more sophisticated, that you then invest at the next day or rebalance your portfolio on the next day to the opening value, so you can play around with that, because this is a daily signal thing, and after the exchange is closed, you can't rebalance your portfolio anymore. But this is maybe only a minor issue if you have such a long-term thing. And now you can plot your returns, your index returns, against the strategy returns. This is not perfectly correct in a mathematically sense. I just take the cumulative sum of all the returns. So yeah, what I do, 24 is the calculation of the log returns, as we have done before. And then I multiply the log returns, which I have just calculated, by the signal values, either +1, 0, or -1, yielding the market return, 0 return, or minus the market return. Yeah?
I think you're using signals from the future here, so you have to shift it back one day. You know what I mean? If you look at the, well, basically, you have to shift the entire returns thing back one day, then multiply it. Otherwise, you'll be using tomorrow's signals to get today's returns.
You mean by the shift operation?
No, that shift is correct, but then you have to take these returns, I think, maybe and shift the entire thing back one day.
Yeah, but this is what I said before. This is all based on the closing value, my signal.
Yeah.
So I multiply this after that with what I've get then. So this is like a math finance. I'm in between two. Both things are in between two days, two points in time.
Well, if you could look at the head of this data frame or return series, for example, at the first couple values. So you would probably have an and there, right?
Yeah, the first one.
Okay. So, but you would have a signal there, right?
Yeah, and this says I'm invested at that day. And because I'm invested, I get the return from this day to the next day, which I've calculated. This is like ex ante and ex post. Like in portfolio replication theory, I don't know if you've ever had the option pricing thing. You set up your portfolio today, but you get tomorrow's return with the portfolio. Then you rebalance it. This is what I said before. I'm rebalancing after the closing bell, so to say. And not saying I'm rebalancing on the next day, in a sense.
But you have an and there, right? Well, the very first value. So you have a value for a signal, which is 0, 1, and -1. And then you have an and because you have no return the first day. Second day, you have a return, which comes from the second day.
Yeah, but you have to think in terms of the time interval. The return is between, let's say, 0 and 1 day, or today, tomorrow. This is a return. But today, I decide to go long. If I'm long today, I will earn the return from today to tomorrow, which I calculated.
Exactly. That's why you shifted back from day, right?
So the shift is in the other direction, I think, from what you think it is.
Okay, well,
Yeah, but I don't. If I'm invested today, I'm 100%. I have 100 euro in the market. And I calculated that the return from today to tomorrow is 5%, say. So I will end up tomorrow with 105. That's right?
Yeah.
So this is what the market moved maybe from 1,000 to 1,050. I invested 100. So the return from today to tomorrow is 5%, and I get the return because today I'm long. The only thing that I said before, this was my critique of my own approach. I use closing values to rebalance after closing. So the exchanges are closed. I can't rebalance anymore. So I have another routine which is a little bit more complex to say, well, the signal is generated today, but I rebalance at the opening bell tomorrow. This would be right to say, well, I have a look at the closing data, then I do my calculations, I do rebalancing, I do everything, and the next morning at the opening tick, quote, I rebalance it. I make the simplifying assumption like 1 second before the closing bell, I'm able, because the signal was there already, to rebalance my portfolio. And then I earn the market return from close over the next day to the close.
So I think the confusion is the sign and the shift. Imagine you would do the shift with -1. Then you would look into the future. But because you're doing the shift with +1, you're not. And I think there's always a bit of confusion about shift is defined.
That's true, that's true. And in the beginning, I remember that it was for me really confusing how to use it. And if you then think of, then there's another problem. It's not always shift 1. The time series can be read into pandas in a different way. So it doesn't have to start from, let's say, the longest day ago to the most recent one. It can also be in the pandas data frame the other way around. Then you have to work differently. So there are many things involved in here. But as I said, you have to take care with the days exactly. So that's actually true. But to finalize this, once again, also a critique on my approach is a simplifying one that I just add up the returns. So this is a cumulative thing. I just put one thing to the other. It should be more like a product. It should be more like continuous discounting or counting, take into account the returns. But you see the cumulative effect is at least approximated by what I plot here. And you see, of course, the huge effect that going short has on my returns. I earn exactly the negative ones. But here in this more quiet period, more or less, I don't earn anything. I have no advantage. But in the end, due to the long period where I shorted the market, I have an advantage. Pretty simplified. You wouldn't do this in practice. But I mean, it's a pretty efficient way to come up with at least a couple of insights and to illustrate how you can work with pandas vectorized operations. Yeah.
Can I ask a question about the signal where you use NP where? You have 2 lines.
Yeah.
Is it worth putting it into like 1 line, or would you just make it unreadable with no benefit?
This is always a question, how you structure these things. So usually what I try to do is, well, I don't know if it's a rule, but when I think back, I always try, when I write down an algorithm, like a recipe for Monte Carlo or something like that, I always try to have 1 line of code for 1 line or 1 element of the algorithm. So maybe you could have 3 here as well, which would make it even more clear, in a sense. You could like mangle it into 1 single line of code. I mean, in the end, this is style. This is style. This is what I said. I don't think there's too much of a performance difference here involved in that case. If you have huge data sets, this might also be an issue to say, well, the one thing is much more performant than the other one. But usually I would go with readability and what you are, well, let's say, fine with. What you like to, how you like to maintain, what your style is, maybe people you're working with. So.
Can you go back in the diagram?
In the what?
The diagram.
This one or the last one?
The last one.
Okay.
How do you interpret the strategy?
What I do here is just like I have calculated the log returns for the index. This is stored in the column returns.
Yeah, I understand that. But how would you interpret the green line there?
Here, well, these are my cumulative returns over time, given that I follow the strategy religiously, so to say, mathematically. Going short whenever my rule applies, going long whenever the rule applies, and being in cash. Excluding any kind of transaction costs, slippage, operational issues, timing, and so forth. So this is kind of in like a perfect market according to Black-Scholes or the CAPM or whatever. Yeah?
Are you going to mention zipline?
No.
Okay.
I didn't use zipline today. And to be honest, I'm not too familiar with it. I use it sometimes, but it's not kind of. This is more backtesting made by hand. What I mean is kind of, if you want to think of it in layers, I start with NumPy, and then there's pandas. Maybe zipline will be the next thing to expose here, in the sense that this is then specifically dedicated to the financial world, where you have even more or higher abstraction level convenience function to do backtesting and retrieving data and stuff like that.
Yeah, I mean, you've also got Quantopian as well, so you can
Sorry?
see all the results, like pretty useful results for people doing this kind of stuff.
Sorry, I didn't hear you completely.
There's also Quantopian, the website.
Yes, I know them, yeah. I know people, I know Thomas, Vieki, I know these guys who are doing that, yeah.
They actually open sourced the platform, I think.
Sorry?
They open sourced the platform recently.
Yeah, it started as actually as an open source project. Then they got funding last year at the beginning, angel funding. Then they got a Series A round of 6.5 million. So now they have budget, people. They're pretty, also pretty popular thing. Good stuff that they do, I know. But still in the more corporate world where I'm in, where we do consulting, people I'm working with, they don't use it too intensively, to put it that way. But there's no critique involved at all, even not in doing that. Well, next thing, I said it's all about volatility, Eurex, VSTOXX. Who of you has ever been doing something with volatility derivatives or volatility indices? Only 1, 2. Not too many. Does anybody have a rough idea what is behind volatility index? Not really. I hope. Well, we have. I think we should have a look first, and then we might discuss the meaning or the approach of it. There's one stylized fact about volatility indices or volatility in general. The stylized fact, when you have a look at empirical books, is usually called the leverage effect, which I mentioned before, which says that if markets come down, if there's a crisis, volatility spikes. If markets are rising, everything is okay, then volatility comes down, everybody's calm, nothing is happening, or not too much, so to say. Translated to the index world, it is a stylized fact that stock indexes, indices, are and their counterparts on the volatility side, the volatility indices, are highly negatively correlated. In a sense that whenever the VSTOXX is shooting to the moon, volatility indices should go down. The VSTOXX should go down. And the other way around. Whenever we see a crisis in the market, whenever we see the Eurex 50 falling down, we should see the VSTOXX going up. And this makes it quite attractive for hedging purposes. Think of an asset manager who has a large equity portfolio invested all over Europe, and suddenly there's a crisis. If he is only long, no hedging involved, he will suffer the effects of the crisis. Maybe by adding volatility derivatives, he might do better in a sense that these provide a huge hedge against downfall. So this is the basic idea behind that. What we want to do and what follows, this is not an exercise, this is just something that I will show, is to reproduce, not proof, but at least indication for the statement for the stylized fact. We used to work with, I think, the most convenient source, finance.yahoo.com. Now I want to go a little bit more native. I directly pull data from the website, from the VSTOXX.com website. This is achieved without any pandas, without any trickery. This is standard Python functionality from URL lib 1, so to say. There is the other one, URL lib 2. But I use URL retrieve from URL lib, the library. And I use this to retrieve these two text files. These are actually comma-separated value files, CSV files. Actually not, because there's a semicolon in the one and so forth. So there's not a real standard when it comes to CSV files, but nevertheless there's a standard when it comes to text files. And these two are text files. They are a little bit cryptically named, but nevertheless you can download them, and they are updated on a daily basis right after closing. So this is kind of a text file where the last line is just edit, 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 day after day, back to the inception of the index, respectively. In the first place, the Eurex, of course, the EuroSTOXX index, and in the second case, the VSTOXX index. Once we have them on disk, now called maybe a little bit shorter and better, es.txt and vs.txt, we can work with them. The first thing we have to do, and now we are like in the middle of the problems that I have put on the table before. This data is not structured in a way that we can work with it or want to work with it, or that pandas, for example, is able to read from directly. If you open this file, again, we are still in the Python world. There's no other library involved. We just open the file, read all the lines, and you see the header structure and everything. This is not nicely formatted. You see sometimes there are no blanks, no blank. Then there's a blank, this kind of, I don't know who thought of this. But, well, it is as it is, and it is quite a while. But this is not actually the real problem. For example, you could tell pandas just to take the third line and skip the first two lines, and to make these the header columns and so forth. This is okay, but there's one thing which changes at the end of the year 2001, and this is the format of the data. So I can show you that. You can look it up if you download it on your machine. I maybe do it a little bit smaller. No, this doesn't scale as I would like to have it. Nevertheless, we can have a look here. You see, until Christmas Day, 2001, there's no semicolon, and suddenly, on the first trading day after Christmas, they put a semicolon at the end of that. This already leads to, let's say, significant reasonable errors when importing this with pandas. Not a major thing, but still annoying, because in the first place, you don't get it. You just import it, everything runs through, but then you have messy data in your pandas data frame. What can we do? Well, we have to do a little bit of house cleaning in this case. We have to get rid of this semicolon or find something around, but I don't want to skip through all the lines and say, if there's a semicolon, then skip it, and so forth. I could do that. I could iterate over the whole file and clean it, or I choose here in this case a little bit of a different approach, which puts me in a position to do the two things, to clean up the header and to clean up the whole structure a little bit more easily. Once again, I read in all the lines. I open a new file where I write my stuff to, so I can change the existing file. And I now write in the first place my first lines, where I replace stuff. I get rid of all the planks. This is more like, I don't know, nice to have. It doesn't have to be, but I like to have it clean. I like to have the column headers clean without planks and so forth. And then I also add, and this is kind of maybe a little trick, it's nothing special, I add an additional column, del, for delete, which I want to delete later on. By adding this additional column header, pandas is able to read it in, and then we can get rid of the non-existent column, which pandas nevertheless assumes because there are these semicolons included from the 27th of December 2001. In the end, we see we have some nice column headers here, no planks, none at all. We have this additional column, which we want to get rid of later, and we have a nice structuring. This we can now read into pandas and can work with, but don't forget to delete the to be deleted helper column in that sense. And now we end up with kind of a cleaned up data structure for our EureSTOXX data. There are also a couple of other sub-indices involved. In the end, we are only interested in the, so to say, real or published or most popular index. It is this one called SX5E. This is the standard EureSTOXX index. The VSTOXX data, this is pretty clean. We can read it in simply. We have here in this case a comma, in the other case we had a semicolon, and so forth. Maybe usually pandas notices it, but it doesn't harm to provide the information that there is a day first, a European convention when it comes to the data storage. So this is a single line of code, no house cleaning necessary. We are only interested in two columns of these two data frames. So I generate a new column, and I also get rid of the data for the EureSTOXX index, which is before the inception of the VSTOXX index. So it doesn't make sense to compare this when there is no data to compare with. So two things in this case. I combine two columns from the other data frames to a new data frame, and I get rid of all the data before 2000. Still, we see we have slight differences. So we will have a couple of not a number values in there. There are 22 more values for the EureSTOXX than we have for the VSTOXX. Again, the issue of missing data. Here we see the head of it. We see completely different scaling. The EureSTOXX starting on the 3rd of January 2000 at 4,800 something, and the VSTOXX being at the level of 30, implying something like 30% for the volatility. So this is the first indication. The VSTOXX is something that is expected to behave mainly like an interest rate. Volatility, it is mean reverting. It can't go negative and stuff like that. So we would not expect the VSTOXX to explode like long investors in EureSTOXX are betting on. So this is kind of a different beast, if you want to like. And the interpretation is that we have here something like percentage points representing the volatility figure. It's an aggregate measure of implied volatilities of out-of-the-money options for puts and calls. So it's a lot involved in that. There's also the website which I referenced on the PyData tutorial website, which we did for Eurex. It's called Advanced VSTOXX Services, where you find all the information, Python script to calculate your VSTOXX by your own. grabs data from the web and helps you calculating the volatility index. It also explains the whole theory. So if you're interested in the underlying theory, you can have a look at this. The link is also provided here in the presentation. Having a look at the data, we already get kind of visual indication for our stylized fact. Namely, that whenever the stock index comes down, see it here, the VSTOXX, the volatility spikes. We have the crisis here, we have a spike, we have the most recent or larger crisis in 2008, 2009, and here we observe the highest level of volatility we have seen so far, at least as long as volatility indices like the VIX and the VSTOXX are in existence. First support for our hypothesis for the stylized fact. What we want to work with right now is with the returns. We have the same thing again. We shift it by 1 day. And we have the returns from the first to the second day, from the second to the third day, and so forth and so forth. And now this approach makes also the data comparable in the sense that we can a little bit better work with them in a statistical sense. It's pretty easy, for example, to apply ordinarily squares regression with pandas. Pandas has included a couple of batteries, but not too many, because there's kind of stats model, SciPy stats, and so forth. Many, many things. A few of them we will see later on in the tutorial. But here we have just used the standard functionality provided by pandas. We just say what is the explanatory variable, what is the dependent variable. In this case, I say EuroSTOXX, VSTOXX. Could be the other way around. It's a statistical thing. We are not mainly looking for like cause and effect. It's only a statistical thing of being correlated or not, and if so, in which way. Once again, the graphic says it all. Here we see a scatter plot of all the returns of the EuroSTOXX against the VSTOXX index. And you see the blue line, which is the linear regression through all the returns, indicating via means of a negative slope that there is indeed a highly negative correlation that we can observe between the returns of the two of them. But even without the blue line, you see that we have something which is negatively correlated. But you might ask the question, does this change over time? Just as illustration, I don't know if you're working with this kind of plot, but I like it quite a bit. We can add a third dimension to it, to the scatter plot, when using scatter itself. So this is kind of a handmade scatter plot, if you like. I just plot dots, x against y or y against x, however you want to turn it. But there is a function which is called scatter. Here you see it from Matplotlib PyPlot, where I provide x and y, and I have a third dimension if I like to. Here in this case, I use a color bar to illustrate it, and this is the information about the date where our returns are from. So I can put in a new view on that in terms of having the time dimension also included. And what we can see here, I think I've written a little bit about that, but let's go through. Coming from the dark blue one, which is like our starting values, we see we had like quite a high volatility environment. It was like a stretch thing. Then we see the yellow dots. They're like the most widely spread ones. This is during the crisis we had in 2007 to 2009. Here we have seen like these huge spikes and drops and things. That's a crisis, what we would expect. And most recently, once again, I said it already a couple of times, we have seen that volatility has come down, and we see all the returns are like centered around the 0 point here in both directions. So the dark red one is the most recent data set, so to say. And we see we have kind of this breathing thing where we see how things are changing over time. Quite a nice means from my point of view to put time data into such a plot as well. Come to the next exercise. We've seen that both indices are highly negatively correlated. We have seen a little bit about the evolution over time. What we now want to test is kind of another stylized fact or thing everybody now believes in, is the question whether returns of the EuroSTOXX and or the VSTOXX, I don't know, are normally distributed or not. for example, if they have fat tails or not. What we want to do is to analyze this in a sense. It's not rigorously, but it helps to get to some hypothesis using a graphical illustration, using QQplot of statsmodels.api, and then a statistical test, which is, I think, a little bit more reliable in the end. And if you like to, I haven't done this here, but if you like to, I have a couple of these examples in my book. In this one, for example, or in a new one again, where you plot the frequency distribution and plot a normal distribution, the probability density function of a normal distribution with the same mean and the same variance. But this we might want to skip. But the other ones might be pretty useful to use the data. If you have the IPython notebook on your book, you should just go through all the steps. It downloads the data, it cleans up the data. In the end, you have the data set, and then use the data that we have and that we used for our regression to graphically illustrate via QQplot the returns and the quantiles. QQ stands for quantile, theoretical and empirical quantiles, to illustrate this graphically, and then to use normal tests. This is just a single function call, to be honest, from SciPy stats to test whether our data, our return data, is normally distributed or not. The first right now is a graphical exercise. Use ggplot to plot the return data of both indices to check whether the returns are normally distributed or not. Of course, you have to import this. Either you import stats models API as SM, how it's usually abbreviated, or you import QQplot from statsmodels.api, and then you can use it. Both ways should work the same. Does everybody know how to look up help information for functions you don't know? I mean, this is a helpful skill. You encounter a new function, and you don't know which parameters to provide, how to get this running. So everybody's aware of that, so nothing can happen. Just apply the function. So you shouldn't spend too long on that. I mean, in the end, the application is pretty simple. Once you have imported stats models API as SM, for example, as in this case, you can have a plot with a single line of code. What I want to do, kind of a benchmark, is to plot normally distributed data. In this case, standard normally distributed data, which I generate on the fly here. And you see, with such a data, if the hypothesis that the returns, the data is normally distributed is true, you would expect this regression line through it, the quantile-quantile line, to be a straight one right across the data, or the other way around, to see all the data points lying on such a line. It's kind of a pretty simple way to illustrate this. You just sort all your data in a row from the smallest data point to the highest one, the smallest return to the highest return. And once you have sorted this, this should in such a plot be, or should look like a straight line actually. And this is the benchmark case. If we see such a plot for our data, then we would say, well, this seems to be like normally distributed returns. If it looks differently, they're not. What would we expect if we see fat tails in there? Any idea? What do fat tails mean when it comes to returns?
More is present at the outliers?
Yeah. Relative, it's only relative fat, relative to what? Relative to the normal distribution, we see smaller values or higher values, either 1 fat tails or 2 fat tails. So in this case, we would expect something which goes lower at the left end or goes higher on the right end. So, and indeed, if we plot the data for the VSTOXX index, we see this is all but a straight line, actually. See a clear deviation, and this is what is meant by, in the end, by fat tails. We see much larger downturns than would be implied by the normal distribution, and we see much larger gains, so to say, positive returns than also would be implied by the normal distribution. This is then when you read in the newspapers, we have seen the third Six Sigma event in 2 weeks. You know, this is statistical nonsense in the sense that this implies or would imply or assumes that indeed a normal distribution is the underlying driving force, and that you draw from the normal distribution and you've seen a 6 sigma, which means it's like a 6 times standard deviation thing. I mean, this would be like over here, something. So this doesn't make any sense, but nevertheless, people know what is meant by. This means that we have seen returns which you would usually see only once in a million years if indeed the underlying distribution would be normal. So obviously, this is all but normal because we have these effects that we have much higher returns than would be implied by a normal distribution. Similar thing with the VSTOXX data, as you can see here. Although it's not a stock index, although of course you would, or maybe you would expect something pretty different, but you see the same thing. No normal distribution. We have much fatter tails. We have these outliers and these. And if you go to, or I might skip back to the colorful plot, you see these ends are like these, stretch out things, like on the top and this. Everything that is on the outside. This is what we see now as the tails, in a sense. So obviously, another stylized fact, at least graphically supported, that we have no normal distribution. There's no random walk down Wall Street. There's something else. And the last thing we want to see whether this is statistically true. What I have done actually is to write up a small function, just a helper function. As I said, you only need to call normal test. But what I also included here is to calculate the data of the skew, to calculate the data of the kurtosis, and also do a skew test and a kurtosis test. And in the end, kind of an overall test, which relies then on the skew and the kurtosis test. So this kind of combined test of the third and the fourth moment in this sense. And you see here a set of test results for, again, dummy data, the benchmarks, then normally distributed random values here. And you see the skew in a perfect world should be 0, and in this case, depending on the definition, the kurtosis should be also 0 or pretty close to 0 at least. And the test values are all above 0.05. Sometimes they're even getting higher, but here you see the random numbers that are returned by Python are not that good in a sense. The third and fourth moment are not well matched, not too well in a sense, but still the normal tests, the skew test and the kurtosis test, all three imply that this is normally distributed actually. If we see a test value pretty low, which means at 0, mainly, then we would say, well, this is not normally distributed. We would reject the hypothesis that the data that we are faced with is normally distributed, but here the values, the test p-values are high enough. Equipped with my function, which I have defined by myself, I can simply put in the data, the return data that we have from the column Eurostocks and VSTOXX. I only take the values, or I could transform it to a NumPy array. And I see this Q for the first thing is pretty close to a normal distribution. So this passes the skew test, but not so the kurtosis, which leads us again to the fat tail distribution. We have usually what we see is high spikes on the in the first place, and we see fat tails. So the kurtosis is completely different. Therefore, this test fails, and therefore as well the normality test fails in this case. And again, for the VSTOXX index, here we have that these two tests fail, but also the skew is completely different from a normal distribution. Therefore, it fails all three tests that we have done so far. No normal distribution for both our stock index and our volatility index. And I want to come to something pretty interesting. We have implemented something. I provide the link in a second for Eurex to do a historical backtesting based on Python, with which we do the number crunching, but the front end is a web-based one using JavaScript. And here you can choose from 0% to 100% the proportion of your equity portfolio to be invested in the VSTOXX index. And the idea is to hold this proportion constant over time, which means when you start out by investing 20% of your wealth in a VSTOXX, then it should be constant over time. Whenever this falls below 20%, you will add to the position, rebalance, and whenever it's above, you disinvest from the VSTOXX and put more stuff into equity. And we will see what the effect is, but this is a very interesting thing because these strategies look like as if they would pretty well outperform the market. Here you get all the links when you go to the website, to the presentation, or you have a look at the IPython notebook. You will find the links. This is the link to the tutorial itself, where you find, this is the link to the study, which was kind of the blueprint for what we did. In this study, they analyze, as researchers do, we have taken this data, this period of time, and we have done this and that, and these are the results. And as I said before, this constant proportion investment strategy seems to pretty well outperform a regular long investment strategy. But what we have done as well is, I might click on that, it's to build backtesting applications where you can test in real time what happens. So I just keep the original dates. You can change them. And what you can do here you see the performance of three things. First, of the EuroSTOXX, second, of the VSTOXX over time, and third, which will come now, the portfolio. And you can say, well, I do want to invest 20% of my wealth in the portfolio. And you see the blue line is rising up. And you can notice two things. It has a similar volatility to the EuroSTOXX, but it outperforms both indices. And if you increase this a little bit further, you see there might be something in the end. Now it becomes pretty volatile because we are closing in on the VSTOXX index. So in the end, with 100% in VSTOXX, of course, we resemble perfectly the VSTOXX index. But there is kind of cutoff point where you say, well, this seems pretty optimal to me. So it obviously makes sense to have at least a certain portion of my equity portfolio invested in such a thing as the VSTOXX volatility index. There's one cautionary remark. I will open the other backtesting application. Of course, you cannot invest directly in the VSTOXX index, nor can you invest directly in the EuroSTOXX 50 index. You would like to use ETFs or futures or whatever instruments or options on the index. The same with the VSTOXX. So what we have done, you've seen before, the simplified version. What we have done here is kind of to make it more realistic with real data. Over the past time, data is available up until the end of last year. You can have a 4-asset portfolio, but you can also use either the hypothetical VSTOXX, if you say, well, this is for research reasons, or I want to test the strategy. Or you can use here the real futures. For example, you can go long, short, next maturity. You have all the maturities that you have. You have different rollover strategies and so forth. So here you become a little bit more realistic. Also in a sense that you can say, well, I will rebalance every time, or I will have different thresholds. And you can also say I have to take into account maybe 2.8% transaction cost over time. So you can make the backtesting a little bit more realistic in a sense, but what this does here, and these are some nice features that I think we came up with. This is now the same thing as with the simple one. We have only two assets. The one is the Eurex 50, the other one is the VSTOXX, the hypothetical, just the index. And you can now say, well, and you see again the movement of the line here over a different period of time. But what you have is two buttons. You can say, well, optimize my return, and it calculates the maximum return over that period, and in that sense, the maximum proportion to be invested in asset 2 here, the VSTOXX. Or you can say, well, I want to have a lowest possible volatility investment. And you see this changes the picture completely. Only 17% would be invested in there. But you see this line becomes almost straight, not taking care of the performance. This is all done in the backend, as I said, with Python. But the optimizations and everything, once the data is in the front end with a IX approach, the rest of the calculation and the presentation is done with JavaScript. We now want to go, oops, sorry, here we go. I don't know what it does. Anything is down there. Yeah. Here we go. The strategy we are going to implement is characterized as follows. With the background knowledge I've provided beforehand, it should be obvious. We have, say, 100,000 euro or whatever amount you can think of. And the investor invests like 70% into a diversified equity portfolio, in this case, a Eurex 50, and invests the remainder, the 30% into the VSTOXX directly. So we abstract from transaction costs and from the fact that this is not tradable directly and so forth. But what we want to do is kind of check the trading strategy with daily rebalancing. So whenever something happens, whenever the proportions change, we will rebalance to our 30-70% proportions. I didn't know why it does not. Well, I skipped to the IPython notebook. I don't know why the presentation does not work that good, but we have everything in here. But what I need first is to read my data into that with a good internet connection. This should work pretty well. Because everything that I will be showing right now is also based on the same data that we had before, that we retrieved from the VSTOXX.com website, that we cleaned up, that we used for the other analysis and the exercise, and exactly the same data sets are now used for the rest of the presentation. So here we go. What we now have to do is to get rid of not the number values. There was one question already before, what do we do with the not number values? I highlighted before that we have still a couple of more data points for the Eurostoxx than the VSTOXX. Now we want to make this the same number, so we drop every value, every index row where we have another number value, and we do re-index our data in the sense that we set everything to 100. That we not have like 4,000 to compare to 30. We want to compare 100 to 100. Makes it sometimes a little bit easier. So in the end, we end up with a time series or two time series which look like these. They start at 100 and develop like from there with the respective returns and so forth. So here in this case, what I want to do, I use, again, the same data frame, though my data frame is growing with what I've been doing. And I do the following thing. I don't say 100,000. I just take 100 to have it again normalized to the level of 100. I say 30% I invested in the volatility index, which means that my equity position will be 100% minus 30% times the investment, which is 100, divided by the level of the Eurostoxx at the first state. This is my initial investment. I can get as many index securities as written in this row. So this is the initialization of the first thing. And of course, the remainder of that, the 30 euro or the 30 something, are invested in the VSTOXX index. If you remember my slider, this is kind of the slider thing to initialize that. What I now can do already is like, well, this is already a strategy. I say 30%, I start with 30%, and I say, well, no matter what happens over time, it just let it as it is. So this is kind of a static strategy, or at least you could interpret this as a static strategy. And if you visualize that and say, well, I start out like this, you see, well, this is okay. Sometimes I have kind of a benefit, especially here in this sharp downturn you see. It's like the bubble, explosion of the bubble in 2001. You see, well, I have a benefit, and here again when it's go down. But over time you see in a rising market, in a bull market, you see, well, there's not too much of a benefit. Again, I have the huge benefit in the recent crisis. But in the end, overall, you see, hasn't changed too much. So in certain periods, I'm doing better. In other periods, I'm doing not as good. So, well, this strategy is not what would amaze investors. What we want to do is what I've shown before with the backtesting application. This is that we do daily adjustments to make sure that my 30% invested in the VSTOXX remain the 30%, no matter what the absolute level of my wealth is. My total wealth can drop to 80 or can rise to 120, but still I want to have the 30% invested in the VSTOXX index and the remaining 70% invested in the equity index. This is what is meant by constant proportion investment. So in the end, of course, you will have index movements from day to day. So there might be daily rebalancings necessary to accomplish the goal. So in practice, you would say, well, I will only rebalance if a certain threshold is passed. Like 30% is my target, but I'm still fine with 32 and I'm still fine with 28%. But beyond that, I will start rebalancing, for example. But here in this case, in a perfect world, no transaction costs, we can just what is prescribed by the strategy. I iterate over all the indices. For simplicity, I just take the running, the numeric index, so to say. The first thing is I have to look whatever invested the day before, I minus 1, multiply this by the current value of the index. We are again with this. I invested yesterday. Today, I evaluate the position that I've invested yesterday. I have like 100 shares, so to say, in the index, but I'm interested in the value of the 100 shares, not what it was worth yesterday, but what it's worth today. The same thing with the volatility thing. I've built up my position yesterday, but I'm interested in the value of the same position today. So you have to take care. This is not a euro position, a pound, or a dollar position. This is kind of pieces, shares in something. And the total value, of course, is the sum of the two. So what I now do simply, so I assume that I can arbitrarily devise, they're infinitely divisible, all the things that I'm trading. I just say, once again, my total value is redistributed, rebalanced in a manner that in the end I will have 30% in the VSTOXX and 70% in my equity index. As simple as that. So, checking what are my positions worth today and redistributing, rebalancing all the things to the other, or to the two main ingredients, namely the stock index and the volatility index. Now I can add all the things up, say, well, over time I've invested equity in the equity portfolio, volatility in the volatility, and multiply this now by the prices to come up with a euro value. And you see here how my data frame now looks like. Everything starts at 100. We have volatility, we have the equity volatility, static, dynamic. The strategies, and give me a second before I come to these positions. Here you see already differences, of course. There is no difference because from the first to the second day, we had the same positions in equity and volatility. But here I start rebalancing with the dynamic position, so you start seeing minor differences in the performance. So here, already over the first 5 days, this dynamic strategy outperforms slightly the static strategy because I'm doing this rebalancing. This doesn't have to be necessarily the case, but here in this case, just to illustrate it, is the case. Now you would say, well, I'm not invested 70 and 30% throughout, but this is not the case here. We are just talking about shares. Once again, this is not a euro, this is not another position. I'm interested more, and I show this right now, in the value of my equity and VSTOXX positions. And if you multiply the volatility column by the value of the VSTOXX index, then you see here, divided by dynamic, the total wealth, you see that a constant proportion of 30% is invested in my VSTOXX index. The same thing, hopefully true for the equity portion. You see the value of my equity portion relative to my total wealth is constantly at 70%. Now, of course, the performance. I mean, this is just the arithmetic. The question is, does it pay off? And, I mean, it pays off tremendously here in this case. As you can see, having this constant proportion investment strategy over this period of time where the index is losing, actually, absolutely, we see here a real high growth of our constant proportion investment strategy. And this is mainly, or the key argument for asset managers who are managing equity portfolios to use these instruments to hedge against downturns mainly. Or, as we have seen before, to reduce volatility involved in the equity portfolios. Now we come to an exercise. This exercise is a little bit different in style, but I tried to do different styles for the exercise. What I want you to do right now is use all the ingredients that we had before interactively, line by line. We had done a number of things. And now write a function, and the function should provide the outcome of the strategy, which means the net performance in percent of our strategy for different constant ratios to be invested in the VSTOXX index. The question is, we have seen for 30% it performs pretty well, but the question is, for 20%, would it perform better, or would it perform better for 40%? And in the end, you should have a function with which you can answer the same thing as I've shown with the backtesting application, where you push the bottom and say, optimize return. And you say, well, for providing different values for my constant ratio to be invested in the VSTOXX index, I get different net performance returns. And now we are looking for something which maximizes the return over the given period of time. We can work with the same period, but a next step to generalize the thing would be to also allow for different periods of time, which would also be pretty easily implemented, but I haven't done it. So give it a try, put all the things together and write a function over which you can, for example, loop and try to figure out which ratio invested in the VSTOXX index maximizes the net performance of my portfolio. And I try to get this running. I don't know why. Here we go. So the only thing I did is kind of reinitialize my data frame, but this doesn't have to be the case. You can work with the data frame from before. But we need, again, of course, the input data that we have used now a couple of times.
This is not a feasible strategy because of the rebalancing issue.
Of course, of course.
Do you have something that decides today and is balanced tomorrow?
Yeah, as I said, the.
If you do, for example, if you trade the futures, then you need the index level to know the level of the futures to rebalance, so that it has to happen after close. So it's not feasible. But usually, one way to resolve that is to decide today the position you're going to get tomorrow at close.
Yeah. That's what I said. I said it already with the other backtesting strategies, the same thing. And as I said, well, our first approach was to replicate the research study that was done. So this is the research thing. You know, researchers look at this and say, well, this is the data, and we do this with the data. I don't want to say that they're not aware of, but in the research context, it doesn't matter too much what operational issues involved are there. So
Instantaneous rebalancing, which in theory in practice is feasible.
It's feasible, yeah. But as I said, with regard to the other backtesting application, not the simple one, Here I'm trying to replicate a simple one, but here we have all the intricacies in terms of futures rebalancing, what happens, transaction costs and everything. So that you can say, well, here we are closer to a realistic scenario. I say, well, I, as an investor, have these transaction costs. A bank might have another one, but I have these transaction costs. I like to use options more than futures or the other way around. So here you can get closer to a real world thing. You also have really all the futures that have been available with the real data included in there. So it's not like a hypothetical thing anymore. You have the real products with the real prices which were observed over time. But still, it's not that it's the right thing. As a bank or an investor, you would do it even more rigorously. This is just like the next step to get closer to this, and then you would say, well, given my operational issues, my strategies, my risk rules, policies, and stuff like that, how would I implement that, and what would I expect as a return?
It is a strong indication of the performance when you
Yeah.
get very close performance.
This is maybe a really good way to put it. This would be like, given certain assumptions, the optimal performance, and how close can you get given additional operational issues.
Is it 48%, 48, 49%?
I have a look. I didn't do any kind of real optimization, so I just iterated over it. Of course, you could do it numerically, like with the Newton Raphson thing or something. So, but I think you're pretty close. I was close to your solution. It said, well, what is the net performance that you've calculated for that?
512, but I could be wrong.
Yeah, I have the net performance, so I subtracted my investment. So it's just the on top, so 500 would correlate or would relate to 560 in this case. And obviously, yeah, we have something here in between. Probably peaks out at that. So this is kind of the level where we have the optimal performance in here. And you see, starting out with only the EuroStoxx and keeping the ratio constant, meaning 100% in the EuroStoxx, this yields a negative performance of minus 35% in this case. On the other hand, only investing in the VSTOXX yields a performance of minus 44%. I mean, this is nothing that investors would expect. I mean, investors expect kind of a positive long-term return, of course, for a stock index. This is a different kind of beast in the sense that, I said it before, this is supposed to be mean reverting. There you wouldn't expect kind of a long-term return out of investing in that. So in a sense, this is actually more surprising than that, but nevertheless, you see mixing up the two ingredients due to the high negative correlation, you can get pretty amazing results. And in parentheses, of course, again, considering all the operational issues, you won't get to the theoretical optimal results. There are many things involved, like transaction costs, operational, procedural things that will prevent you from reaching the optimal level. But nevertheless, you will do better if you do some kind of VSTOXX investment strategy compared to not using it at all. And this doesn't say that this is the only way to achieve something like that, but it's kind of a pretty efficient and nice way to achieve better performance for equity portfolios. We're pretty good in time, so I come to my last topic. I haven't even prepared an exercise for that, but we didn't pause at all. So, I mean, if we finished a couple of minutes earlier, it would be fine. Also, in the end, if you have questions or anything we should discuss, I'm more than happy to take questions or to have a group discussion in here. But the last topic I want to illustrate here in terms of interactive financial analytics is the analysis of high-frequency data. So far, we have been working only with daily closing data. I mean, this is kind of a standard, and to be honest, if you open a textbook, even current editions of financial textbooks, the whole finance theory mainly that we have today is based on daily closing data, so to say. This is available since almost 100 years, When it comes to high frequency, the landscape is a bit different. So here we don't have anything that is even close to kind of an established financial or economic theory. All the models, all the things, all the trading, all investment that you see here is more like kind of an ad hoc, is a micro market microstructure thing, or like exploiting inefficiencies in the market which are like technically detected. But we are far from having kind of an established theory which compares to the CAPM, to other things that we know of, even if they are not like supported by any test you can do. We have done tests ourselves where we reject the hypothesis that returns of an index or volatilities are normally distributed. And this is kind of a major assumption underlying, for example, the CAPM, the capital asset pricing model, to name just one. There are many, many other theories that use this simplifying assumption. But here, still, the whole world looks a little bit different. But this doesn't mean that we can analyze the data quite efficiently in a similar way. So here what you find is maybe a source which is not too popular. You find it on a couple of quant websites in the internet. Netfonds is a Norwegian online broker, but they have kind of a nice API where you can access intraday or high-frequency data. You can access tick data, and for the majority of especially US names, like Apple or Google or you name it. Here, Apple is one of my standard, my running examples. And you can access it via kind of a web service, web call, where you get back a comma-separated value file. And here in this case, I do the thing for the 19th of February, so pretty current this week. And what we do here is, from a Python point of view, pretty similar to what we've done with the VSTOXX and the EuroSTOXX data when we retrieve them from the stocks.com website. Here in this case, we just retrieve via another call a comma-separated CSV file via URL retrieve, which we have imported before. So with this, from a data analytics point of view, is completely different data in a sense that you see it below. Once we have imported the data pretty easily, there's nothing specific involved, into a data frame, and we look at the info about that, we see like 15,000 ticks per day. So if we do the math, 250, to make it simple, per year, which means, or trading days per year, which means roughly 2,500 observations per 10 years, which means 7,500 per 30 years. To double that, so we have 60 years that we need to get 15,000 data points of closing data. So to put it the other way around, with regard to my remark about theory, here you have in one day the same wealth of information that you have needed beforehand 60 years together for a single stock. So things are completely changing, and I mean, this is only one of the reasons why maybe it's a little bit more difficult to come up with a theory. When you have a look at it, of course, over a whole day, there are different periods of time. I mean, what we are mainly interested, of course, is kind of the period when markets open at 10 o'clock here in this case and close at the end of the trading day. In between, overnight, there's nothing, and here's kind of a line that pandas draws between the two data points, but there is no action, there is no data point. And what you notice already here is kind of thing that we have heterogeneous time intervals. When you work with high-frequency data, you won't see just like second ticks or minute ticks or 5-minute ticks. Whenever you see them, they are like provided by data service providers like Thomson Reuters. There you get 1-minute bars, tick data. But tick data does not come in 1-minute bars. Tick data comes when they come. So sometimes 3, 4, 5, 6, or even 50 quotes per second, sometimes nothing at all for like a minute. When you want to do that, you can do you can import data here from the source and have a look at the data typically around noon. Around noon, you will almost always see pretty quiet periods where people don't do too much in the openings, and usually At the end of the day, there is pretty much activity, so you would expect to see much or many data points and much activity here at this place, and a little bit of opening, you see it here. And in between, it depends on what's going on, if there's a press release or whatever. But once again, you have heterogeneous data, and this is not kind of like nicely structured, which represents usually a major problem, I wouldn't say, but you have to take care of it at least when you want to apply certain functions or want to do different things with your data. What I do here with this line of code is just to get rid of data before 10 o'clock at that day, such that we have only the data over the opening hours. Where pandas is really strong at is with resampling data. To attack the problem or the issue that I raised before, pandas provides the wonderful method of resample. I can provide a rule. For example, here in this case, I resample my data into 5-minute intervals. I then say, how should this be done? I mean, there are a couple of things I could do. I could do maybe the most left data point, the most right data point, the maximum over the interval, the minimum over the interval. Here I take the mean. If this is financially sensible, I don't know, I just take it. So maybe you would like to have the last observation point in that interval to represent the data over that interval. But nevertheless, you have all the options, and you can decide how to work with. And what I also do in the same line above is to fill all the intervals that don't have any data included in it with a forward fill method. So I take the last point and I fill just the data, or I fill the interval with the data point from my last available observation from the most left data point in a sense. And you see, now we have a heterogeneous data set, heterogeneous in the time dimension. We have observations over the day in 5-minute intervals. Or maybe another question, how many of you work with high-frequency data or intraday data at all? A couple of you, 4 or 5. Do you see these problems, or I say, well, it's kind of, we're just processing these, so we're getting them in and providing them to the front desk or something, so we don't really care? Or do you see any issues with working? Which ones? You have, throw them at me, I want to learn.
There's all kinds of issues. The providers provide bad data sometimes.
Yeah, of course.
You have to filter it out.
Usually what you do maybe is kind of having a look at it afterwards. So working real time with data, of course, is something different than having a backwards look. Data quality is always an issue. So, I mean, also performance. Do you really get it real time or not? If it's tick data and there are like 5 ticks per second, how fast do you get them? And all these things. But, I mean, this may be one of the more simple problems, but with pandas you can tackle them pretty easily to like resample them into different intervals. Of course, what you can do then, you can always do that. You can visualize and plot your data. Here you see this is not as erratic as we have seen it before. So this corresponds to the right part, so to say, or the right half of this figure where we have these erratic movements. The heterogeneous time grid. Here you have the homogeneous. This looks more like, at least to me, felt like, or feels like more like a stock price movement. I say, well, I can see what's going on in here. Sorry. But this is not the only thing that you can do then with it. And this brings me already quite to the close. What I really like about pandas and data frame management is that you can apply so many things to your time series. And this is just one out of the many, many examples where I apply a custom function. If this function makes sense, I don't know. I would suppose not, a strong not. But what I can do here is apply anonymized or lambda function, or you define a function before and apply this function f, or whatever you call it. And you can immediately do operations on your time series data. Here in this case, what I do is kind of typically the story that I'm telling. Apple management isn't too pleased with that, so they call the exchange and say, well, apply this function to our stock price, and you see this is mirrored at 540, I think, yes, at 540, and it mirrors just the evolution, which was kind of a bad day for Apple stock, now becomes quite a good day. And you could do like any analysis, any stuff like in the world of pandas on the data frame. You don't have to go outside, loop over this, define something, and write complex classes or something. So one statement that I used to stress during my talks and tutorials trainings is usually you have one idea in your head, and this one idea generally translates into a single line of codes when working with IPython, pandas, and the scientific stack, which I've touched upon briefly before. So this is, from my point of view, at least one of the beautiful things when working with Python, pandas, and IPython, that you have a thought and you go to your machine, and usually it's a single line of code away that you get the result you've been thinking or dreaming of. This already brings me to, not completely to the end, but to my final remarks, so to say. Why Python for financial analytics and visualization? Some of the standard slides or bullet points I use. But I don't have to use them with you, actually, because in the beginning when I asked, everybody's using Python, everybody's using IPython, everybody's using pandas, but I think there are some good reason why you do that. I think Python, first of all, when I talk to business and decision makers, I stress the point more often than not is kind of that is a multi-purpose thing. Many people say, and I had this last week in Madrid where I gave a talk at a large company, a telecommunications company, and they were like, what do you have that R doesn't have, for example? So, well, R has so many nice things. It can do the nice plots, all the analytics, all the statistical things. But when it comes to production, for example, and deployment in a larger context and scalability, I think there are limits. When it comes to web development with R, maybe there are limits attached to that. When it comes to systems administration, maybe there are limits to using R. Of course, there are limits. But using Python provides kind of a general framework, a general consistent, unified environment to touch all the things like prototyping, which quants are typically doing, development, real development, the expert developer who is using Git and testing and stuff like that, and in production systems administrator, Python is one for all. And I think there are hardly any other language that can claim that. Even Ruby, which is nice from syntax and so forth, but name me the corresponding elements or members of the scientific stack that I've shown today in the Ruby world. I think there aren't too many which compare to the things that we have to provide. The libraries, I mean, the number of libraries, it's growing so fast. And even when you have a look at the current documentation of pandas, more than 500 pages, a single library today is so powerful. So many things you find there. It's also one of the recommendations during a training. Before you try to implement something by yourself, first Google it up or ask an expert, is there something that I can use for my specific problem? More often than not, you will find a solution in a single library, which you might not have been thinking of before. Efficiency, I think Python speeds up all the tasks around analytics or development, deployment. Maintenance, I think maintenance is an issue. There was a question of, should I write 2 or 3 lines of code here? I mean, this is all kind of balancing readability, sometimes performance, but in the end, it's all about maintenance. When you get to your code later on, and when you have production code, it might make a difference if you have like a APL-like thing where you have in one line a whole program, or you have like 10,000 of lines of C++ code, or you have kind of a, well, pretty well formatted and very good readable Python code of 100 lines of code. I think this is one of the things that also differentiates Python. Not the only thing, but it's also one that comes on top. Performance. From my point of view, Python has overcome the major prejudice that it's interpreted that it's too slow, in a sense that Python has become like a glue language, not between different systems, but also between different high-performance technologies. We at Continue, for example, are working heavily in these areas where we try to make stuff like dynamic compiling via LLVM easily accessible, or the use of multi-core CPUs, the use of clusters, or even GPUs via high-level Python scripting. You may remember the vision that I introduced before to move these high-level abstraction paradigms and the knowledge, the insights, the expertise of the business decision makers and the analysts closer to the code. And I think this needs for better tools, and we're working especially in these areas to make stuff more performant, and not in a sense that you need to go to university again and study all these parallel implementation paradigms, but that there is something that helps you with harnessing the power of your available hardware much, much better. Interoperability is also something. When this guy last week asked me about R, I say, well, R has so many fine things. That's the reason why there is a bridge R to Py and stuff like that. You know, Python is, I think, one of the few languages where people are pretty open to everything. Everybody's working on like making Python even more open, more integrated into other worlds. We don't want to say that, well, we replace everything that R has to provide. Not at all. I mean, that's the beauty that Python tries to overcome the boundaries and say, well, R has so many good things. We want to include that into our world. IPython is starting. I read like a tweet from Fernando Perez. They have kind of like a sandbox thing, including R into IPython, that you can execute R code from IPython. The same is already available for JavaScript, for Julia and everything. So all the tools, the world, the whole thinking is pretty open. And interoperability in today's landscape is pretty important, I think. Interactivity, not too much to say. We have done this the whole day. The last point, maybe collaboration. Also another area, when I have to point another one, where Continuum is intensively working on. And I want to highlight our Vakari, which has come out in a new version recently. So with our Vakari cloud version, we had always had these kind of things. Well, it's pretty nice and it's pretty cool and on AWS, but we don't put our data on servers of Amazon or to this end on anybody else's servers. And we have all these firewall issues. I can't get through. I can't do this and that. And we've heard this. We've included this in the whole thing. Many things have been reprioritized. There are two new things. I want to highlight the one thing. This is Vakari. Actually, we recently came out with a Vakari Enterprise version where you can install. But first, before I go on, how many of you know Vakari? Have ever seen Vakari? OK, so you should give it a try. Maybe start with the cloud version and then go to the Enterprise version. Vakari is a product that has been around quite a while, and it provides Python deployment via the web browser. It's a web-based, cloud-based, interactive, collaborative data analytics environment, mainly based on Python. So you have a complete Linux box. When you log in, you have your shell, you can do everything, but you also have IPython, you have file manager, you can upload data, you can share data. You can say, well, this is my IPython notebook, this is the data I used, and then you make bundles and you publish that, and other people can download everything. For example, my IPython notebook, if I would have used kind of proprietary data sets and specific libraries or anything else, I could have done a bundle and published it, and everybody could have downloaded it and executed it on the same technological basis as I've used. So collaboration is one aspect, but also deployment of Python. Think of large corporations who have to deploy Python on every single box, desktop box, server, on all the notebooks and so forth. Vakari Enterprise is a pretty neat way to deploy behind the firewall on your servers, on your machines, Vakari, to provide all the collaborative, interactive things to deploy Python without installing Anaconda or anything else on the machines you have, and to work collaboratively. You see, this one concept, I don't know, it's not on a screenshot. It's all centered around projects where you invite people, you share files, you share results, and you have people working with it. You can add people, you can subtract people, you have different rights and roles. So it's all that you would expect from an enterprise version. And the beauty of it is kind of you can try it. So during our last telephone conference, there was Ian who said, well, my record in installing it. So this is, of course, something you have to install. If you want to do it on your own machine, you have to install it. The record on, I think, a DigitalOcean box was like in 6 minutes. It was completely up and running. So maybe you would expect or should expect more like 30 to 60 minutes for the first time. Well, the expert did it in 6 minutes. But I think it illustrates how easy it is to install all the functionality, IPython notebook and everything, up and running behind your firewall on your servers, and to try and test and start collaborating immediately. But not too much about that. It was just to stress and to highlight that we take all these issues seriously, not only the problems that I mentioned, but also the beautiful things about Python where Continuum Analytics is working on. And Vakari is one of the things that we are working on in terms of collaboration and interactivity. There's also Anaconda Server, which allows you to deploy Python much better behind your firewall. But in the end, a couple of Continuum guys are around here. Francesc, for example, I've seen Matt, yeah, he has raised his hand. Matt was in here as our director of sales. He flew in from Austin yesterday. I think he's in short trousers because his luggage got lost at the airport. He picked up the wrong one, so he doesn't have too much clothing, I think. And many, many others of us. We have a booth out there. I will put my book there if you're interested in. If you have any questions, I'm more than happy to take them. And apart from that, you find all the information about me and us in the tutorial. Thank you.